Just check if the audio is working. Testing. Okay, it's working. Awesome. Hello, everyone. Welcome back. Today I have two things I'm going to be overviewing. So today, we got a big PowerPoint again, which I found is very interesting. So we're going to be covering bonds and Bitcoin, Barbell strategy, and then financials and WSR analysis. So before I go into it, so none of this should be taken as financial advice. It's just a simulator that I play. Like a lot of this can be somewhat related to real life, but I do find it very, very interesting to cover this and everything. But you should seek personal advice from like a licensed advisor in order to pick your perfect investments and everything. But before we go into that, I was just it's a slideshow again. Okay, so we got the bonds and Bitcoin strategy and the financial analysis. So table of contents, basically we got terminology and references as in last time. Basically the barbell investment strategy and then the bond barbell, which we covered in last video for bonds. We got time decay and premiums for leaps. I didn't do too much work on that, but this was originally going to be the video idea. It's just a very, very short video on, and then we're going to play a Wall Street Raider, but I decided to add a lot more content over the last week or so. And then we got the banking simulator. So I started a new game for 20, where I started a random name bank controlled by my player. So I did weighted average default, personal, no business, government bonds, the interest margin, so we covered that a bit in last video, and then bad debt reserves, loan to deposit ratio, before and after Q1 2026 screenshots, and we got insurance, which is the say it's 19 game save, which was when the rates were a lot higher. And it's what I did for like the yield curve and all that other analysis that I did. So we got the weighted yield to cash, weighted yield and cash to liabilities, Macaulay duration, modified duration, yield to call, which I did figure out on Wall Street Raider. You can get yield to call. And then we got interest coverage. And we got interest coverage ratio and then probability to default. Banking in-depth analysis. So I looked at a publicly traded bank in the game, and I did a whole bunch of analysis on this. This was probably the most complicated, especially the bank loan analysis, just because there's so many moving parts with the bank loan analysis, because this bank owns a lot of bank loans. So it's just a summary of the information, bank loan analysis and credit spread over the CD rate, weighted default and all hold-ins, net interest margin, and then the bonus was cash to market cap. So I feel like that's the fastest way to hit 1 trillion once you hit like mid-game. Or if you're really quick at the game, it's considered like almost near mid-game. Okay. So we got terminology and references. So investment grade bonds, AAA to BBB, investment grade range. We got my old PowerPoint. We got the definition for BTC, which I use as an acronym, Ethereum, WA, which I use once or twice, which is weighted average, call contract. This is pretty important. So the call contract is basically the right to buy something. Give the right to buy, but not the obligation to buy. But when you sell, you have the obligation. And we got leaps, which are pretty important. Basically, I want to take advantage of like long-term options on Bitcoin and Ethereum in the game. So you can see what leaps are about. So they're long equity anticipation securities. So they're 1 to 3 years. And we got theta, time decay. is a measure of the rate of decline in the value of options due to the passage of time. Time decay accelerates the option's time to expiration, draws closer since there's less time to realize a profit from the trade. Hopefully the background noise isn't too loud. I have my air conditioning going. I'll probably turn that off actually just to be sure. Time decay is the change in that. So how it works, like, so I use this image right here. So like, for example, we have a 9-month contract. I usually like to do greater than a year in the game, but like you can see basically over time as it gets closer, your value of the option go down a lot. So we want to do 1 to 3 year options later on in the game. In the money, ITM, out the money, OTM, and then there's also in the money, out the money. And there's also ATM at the money, which I think I forgot to add over here at the money. Strike price is a price that you agree. Right to buy, but not the obligation. So like the strike price is the call option where the security can be bought as the option holder. So it's kind of like you're buying a future price. You're buying right now, but for a future date. ATM is at the money. Floating versus fixed rate interest rate swap. This is what I use for the bank in my banking video. So fixed to floating, I think that's when you're like bearish, and then fixed floating to fixed or something. Doesn't explain too much about that, but it just explains a bit of the basics. Counterparty risk, which is the person who's buying the contract from me could potentially default on their payment. CD is bank deposit, FDIC insured. So it's up to 250K per depositor. So here's the barbell strat. I got this from a YouTube video. I'll turn off my camera. So barbell investment strategy. So you can see right here is your laddering strat, which is not the barbell investment, but it's just nice for lower rates. So you can see if I do it for 5 years, the Macaulay, I'll make my money back in about 2.78 years, or the modified will be 2.62. So every 1% change will be 2.62 negative or positive. So if rates go down, I make 2%. If they go up, I make 2. Like if they go down, I make 2.62. If they go up, I make 2. Like if they go up, I lose 2.62. But if I do a barbell strat, which is 3 year and a 10 year, because you want to avoid like the medium term stuff. Basically, my Macaulay and my modified go up a lot, but if the rates go down, which I want, so like it's good for when I think rates have peaked, and the ladder is good for when I think rates are going to go up. So it spreads across the maturities. So here's the asset allocation I plan on having for the game is 50% low risk, which is T-bills, CDs, government bonds, and corps. 50% high risk, so we'll do Bitcoin, Ethereum, and Leaps. And then later on in the game, around 400K in the game, you get options unlocked. So I'm going to probably do half Ethereum, half Bitcoin. And like here's an example of like Bitcoin for the Bitcoin ETF, so you can see how much you're up on or how much the ETF's down on. And maybe every now and again I'll choose to break the 50-50 rule. Like if I see that rates are above 6 to 8 for the long rate, for like the long government bond, or if rates are low, I might go more into Bitcoin. Or I'm gonna probably end up using the coupons from the bonds in order to buy Leaps. That way potentially I can lock in a good price, and then maybe if my bonds do better, then I can basically convert like the options to actually hold in the ETF, or I'll just be leveraging my Leap options to make some good profits potentially, or I'll just lose everything. Like I could speculate on Leaps. And behind here is just the source, so if I do, so I got this barbell, man lifting barbell image. So I'm going to try to stick to the 50-50 for the most part in this challenge. So I think my camera can go back on. Better read the top then. So the barbell is holding short and short and long-term securities, avoiding intermediate term to benefit from higher yields and reduce interest rate risk. So for example, we're gonna avoid the 4 to 10 year bonds, avoid them. But anything greater than 10 years or equal 10 years, I bet I'll probably be buying. So I'll be buying the 1 to 3 year. But that, like, if interest rates I think are peaked, but if they haven't peaked, the 1 to 3 years will basically be basically a hedge, and then I can do longer term to take advantage of that. So here's an example of like a barbell portfolio. So a barbell mix, 3-year corp, 10-year short government. So you can see like it's 5.25 for the modified and 5.39. If I do a 3 and 20, then it's basically 7.2, 7.42. And you do a mixed, so you do 3-year corp, 10-year, 20-year. You get 7.35, 7.57. Yeah, you can see like a investment grade portfolio. So like I did this in the last video where I went over like an investment grade. So like this is what I'm probably gonna stick to with the challenge is I'm not gonna buy any junks, because like as you can see a triple B for 2041. So that'll be the starting year was 2041. Like is when it's due. So it's about 15 years. And it has about almost less than a 1% chance of default over that year. So you have 15 years. So like you can see, even investment grade are still relatively risky over a long period of time. And we got Barbell Strategy Corp Bonds, 3 and 10, 5.09. So you can see basically that a mixed with the government, like that, I feel like it because the corporate bonds have a higher coupon. Basically that makes the Macaulay and the Modify a lot lower because they have higher coupons than the government. And if you do a 1, 2, 3, 10-year and 23-year corp, because unfortunately you can only do two governments in the game. You do the long and the short government bond. So there's one that's 10-year and one that's 20. So I did a 1, 2, 3, 10 and a 23-year. You got still pretty low rates compared to that. That's also because I spread it across more. But if you do a 3 and 23 year, kind of like this, it's about it's a little higher in the Macaulay, but a little lower in the Modified. So like, just because you're at an extra 3 years, so they're about comparable, which is interesting. So here's the leap. I already clicked on this image. Basically theta decay, which I don't think they cover much in the game, but I just find it interesting buying the longer term stuff. Okay, so you can look at time decay, theta decay, and out the money, and in the money prices of calls. So a deep out of the money call, as you can see, a 1 year. So the start date was, I think it was October 2028 or something. So I basically looked at a year out in the future. And if you want to do it for 2 years, which I think is the max, almost 2 years is the max, you can get paid $40 per contract, or 23. So with options leaps, current year is 2020 October 2028. Budget is 17,000. I do skirt the budget by a little bit on the bottom, but you can see an out the money option is 2,300 for 1 year. So you would have to make greater than 25% because it's 213. No, it's 213. Yeah, it has to go above. So at the money is 170. 170 times 1.2529. Yeah, so you can see it's about basically, you have to make about 25.59 in order to break even on the call, on the out of the money call. At the money is 404, because you do that times like 100, and in the money is 6,000. So as you see, when it's in the money, like So 100 shares at the money is 170 times 100, 17,000. So like if you want to buy 100 shares outright, it's going to cost you 17,000, but you can buy one call for $4,468. So like that's at the money. So if it goes up, then you make a bit. Or you can buy 3.8 contracts, but in this case, I rounded it to 4. So you'll be about 872 over budget. But basically, you could have 400 shares of leverage versus 100 shares of leverage. But you're limited by the time. So like that's why I like buying the longer stuff. I don't think it showed much of the top. My bad. So instead of paying 68,000 for the ETF, so if you want to buy 400 shares, it's 68,000. But you can put all your money, basically all the 17,000, into 4 contracts. Therefore, one leap is approximately 73.71% cheaper. But the thing is, you get kind of screwed over by the time if it doesn't go up in price. Okay. So that ends the barbell investment strategy. So you do a bit of low risk and high risk investments. But we also got this. So financials. I was kind of interested in like looking at how much of a risk it is to buy like consumer loans and everything, and just looking at banks in general. So we got basically prime mortgages. So if you have 50% of your weight in, which I often go for in the game, your default chance is 3.15. So your weighted default is 1.5. Subprime mortgages, it was actually 7% in 2002, 14.6 in 2005, 20.50 in 2006, 21.9 in 2007. So the average is 19%, or 16 including 2002. So this is the Federal Reserve of Chicago. Their definition of default is greater than or equal to 60 days or more overdue past 12 months. So you basically see where I got this information from. Subprime mortgages only account for a quarter of the total outstanding loans in the United States. This is kind of outdated. It's like 15 years out of date. But at the same time, like I like to just at least have so much of an estimation. 75% of prime with good credit. For example, prime loans made up of, in 2005, 2.2% were defaulted. 2006 is nearly doubled to 4.2. And where was another 20% to 4.8. By comparison, the percentage of subprimes after 12 months, 14.6 in 2005, 20.5, 21.9 in 2007, but in 2002, 7%. That's where I'm getting that amount. That's the same source, my bad. So basically I averaged it. So we got 14, and so I got 16%, including the good year, which was 2007, but it could be 19%. So subprimes aren't really that good, in my opinion, in the game. You got consumer loans, which I also did primes, which is greater than 60 days. So consumer loans is 30%, 4.21%, including the 1.4. So it's 2.20, 4.20, 4.80, 3.73, or 3.15 including 2002. So the worst case is 2005 to 2007 is 5.91, but I'm assuming 4.4% rated default for our financial company, the bank that we decide to own, like start. So we got the NIM, which I basically did all the offsets up here, and a bunch of others. But we got the prime mortgages, 50%, 5.2% rate. So I got that from a screenshot of the economy, like the interest rates. So you get 2.6, subprimes 7.5. So you see potentially in the past, 16%, 7.5. Doesn't seem that good, but that's why I don't weight them too heavy. And consumer loans is 30%, 11.25, 3.38. I think we did consumer loans is 4.21. Oh yeah, this is also where I got all the consumer loan default rates. So the delinquency rate, 4.21 is the mean. But if you want to be extreme, you could actually do the max, which you can actually get the max data. I think there's a table you can get somewhere where it shows. I literally found the table yesterday. I think I actually have it linked somewhere. But like basically in the bad year, yeah. Prime mortgage is 50%, 5.2. Consumer loans 30%, 11.28% interest rate. So you get 6.84 weighted average interest rate. You get certificate of deposit rate, which is where is it? I think I just wrote it down. Yeah, so the certificate of deposit rate is 2.02. So you get the interest rate from all your weights of your bank loans. Subtract out 2.02, you get 4.82%. And so the weighted default is 4.44 in the previous slide. So I rounded that by 0.2. So you make it about 0.38 after default risk is accounted for. And so the first quarter of my company, provision for credit loss was $65 million because I wanted to take advantage of potential more defaults in the future. So I wrote off $65 million. So I had 54% of my net operating loss came from that. So I lost $118 million, but I wrote off $65 million. So that's where the 54% is coming from. If I didn't write off that amount, then basically I would have made about $65 million more, but I would have still lost money in the first quarter of the game. But you can see my bad debt rate has gone up to 0.474. You get reserves to deposits, loan to deposit ratio. So before my Q1 report, it was 82%, but it went up to 94. So I increased my bad debt by 65. So you can see basically right here, there's also another source that says that what basically a bad LTR is, loan to deposit ratio. So a high LTR suggests that most of the deposits are lent out, hinting at robust income generation but potential liquidity constraints. Low LTR indicates conservative lending practices, which could be seen as buffer against risk, but also means that the bank is not generating maximum profit. So we did total loans divided by the deposits. So you can see right here is acute. I'm looking over here though. This is where I got the very, very risky. So we're at 80 to 90, which is considered the optimal range. So right here, we're considered optimal. But then a little bit later, by the way, this is, I think, 2,000 divided by 70. Yeah, I think that up there is actually this. So basically, that's how I got 82. But then there. So I'm basically above 90%, which is this aggressive lending, which could lead to heightened liquidity risk if the depositors basically withdraw their funds quickly. Conservative approach and elevated liquidity risk. So we have quite a lot of liquidity risk for the bank. But the thing is, in this thing we had 2,000, but it's likely we're gonna have pretty high liquidity risk in the game. And we also got the before and after Q1 2026 screenshots. So this is what I did for my asset allocation: 50%, 10, 30, 0% corp and government bonds, 10% cash, and that's where I got my rates. So we have 11.28, 5.2, 7.6. This was right here. So that was before the Q1. So our lending rate was 2.02 for the CD rate. So honestly, our NIM actually went up a little because after the Q1, it went up to the CD rate's now 1.35. So basically, if we go back, our NIM would be a little bit higher because we have less like CD rate. So I did say in games 20 after I did interest rate swaps. So breaking news is 3.45 for the short bond. So what I did right now is I did pay fixed during term. So I pay a fixed rate at 3.45, and so if it goes above 3.45, I basically make print money. But the risk was I wanted to, like, that's also another reason why later on in the game I included a sample bank. I wanted to show how much interest rate swap risk I have, along with the whole fact that we have a high loan to deposit rate. So we basically have interest rate swap to assets 173%, or about 10%. So like I did the max amount of interest rate swaps the game lets you do for one contract. So I gave the bank 500 million worth 850 million, and so now the equity is 1.3. So that's where I'm getting the 1.3. So that's how I'm getting 13 billion, because I started the company for 1.3 bill. And there's my 3.45. So we have 5 years to make money on this contract, basically. So we got insurance, weighted yield. So this was in-game save 30, which was what I did on the last video where I did the yield curve and everything else. And defaults, probably defaults. But we got cash 3.3% rounded, 0% yield because we have it in Leary cash. Weighted yield 0%, but we got T-bills. So the T-bill rate in this game in this save is a lot higher. As you can see right here, T-bills is 0.92 in the bank save. So we get paid to basically keep money in safety. So we have about 60%, and so we get 5.26% for risk-free. I bought a very, very long duration, so I think it's 2026 is the current year. And so basically I bought a long-term long duration, so I did 33% at 11.85. So I get 3.91. And then subprimes, I did 3.28%. Didn't want to risk too much, so I did 14.10. So I did 0.46% weighted. So we're getting 9.64%. And we don't have to worry about paying back we don't have to worry about paying our depositors any money, because the insurance policy reserves is just money that we owe. Like that's just yeah. Like we don't owe them any interest on that basically, but we do have to keep a lot of cash on hand in case they potentially want in case they gotta pay out the policies. So that's why my cash liabilities is a 9.59%. So the Volkswagen 2051 analysis and others. So the Macaulay duration was 9.7. It's 25 years to maturity, which it says long term. And then the modified is 9.16. So likely the Macaulay and modified would be a lot higher if it was trading at par, which I actually think I did. Yeah, so I did over here. The Macaulay would be 13.26 and then 12.52. So that's if it was trading at the par value and it was only yielding 6.25. But the yield to maturity is 11.85. So you can see, as you can see, because this is a deep discount, it basically like you make your money back a lot quicker on the Macaulay and it's less volatile. Interest rate coverage ratio of 4.6 times, which is pretty good. And then probability default to the end of term, 8.62% or 0.36 per year. So I feel pretty comfortable holding that for 25 years to the maturity end. And then here's a little screenshot down here of the yield to call. So you can see it's 6.25 subordinated debentures, 93 billion, which are due in 2051. It was 20. Yep. Okay. And it's 105%, which is $1,050. Callable in 2042. The largest one is the Bull Insurance, which I think is us. And the yield to maturity, I think, actually went down a little bit, and because I think when you pause, sometimes it doesn't pause. So the coupon rate 6.25, 3.15 semi-annually, 3.13 eventually. So at the current price, I think it was 6.11. It's 5.9, and then you can see basically your break-even price is 2050. So it's 31.25. So that's where I'm getting that times the 32, because 32 semi-annual payments. So you make $1,000 in interest if you hold it till the call date, and then it's $1,050 for the call price. So if you pay literally $20.50, you don't make anything. And we can see like the subprime weighted, so 3.82, 16% probability default. So we get the total weighted default. So 63.74% of our money is in these risk-free T-bills and cash. 33% is in a 0.36% default like bond, which is an A grade. And then we got subprime mortgages at 3.28 weighted probability default. So we get 0.64%. Oh, I think I messed up a little bit there, actually. Something. So like basically that would be that right there. So 0.5. So it'd be 0.30. Made a mistake, sorry. Plus I don't know. Yeah, I think that's a little bit of a mistake there with my weighted average. So it's likely higher or lower. Here's our sample bank that we looked at. So we basically summed up the 23-year payments. And by the way, this rate was at the lower, was at the bank one where the T-bill rate was 0.92%. So we sum up all that weights. It's 16 times duration, a modified Macaulay duration. Modified 16.22. Yield to call is 31.8%. So you're getting $32 in coupon payments. It's actually a lot lower than that. So it'll be $16.25. Yeah, you get, oh yeah, I made a little error there. It's not 32, it's actually 16. So then basically your break even will be 1960. So you can see that like the company has 90 billion in interest rate swaps, while I have 13.4 billion. The bond issues are 3.25% due in 2049. There's $1,050. It doesn't state the break even, unfortunately, for the interest rate swap. You can see right here where I said earlier, basically the interest rate swap to assets for this bank, it's 6.04% versus 173% for my company control bank, or 42% based on the equity versus 10 times for me. So the net interest margin for the non-controlled bank is 4.06. Loan deposit ratio is 94.42. And then reserved deposits is 19%, and then bad debt reserve is 2. So you can see like about 10% is their bad debt ratio to equity. So this is probably the thing that I think has the most amount of errors, or just the most amount of moving parts, is the bank loan analysis. So the auditors basically did a report where about $102 billion of the $463 billion portfolio is non-performing loans, or approximately 9% of its portfolio. Its largest problem is in Subaru. So we can see right here, Honda 11.5% weigh-in, single B 6.5% weigh-in, default yearly. So I got this from Aswaf Dormadon's distress template, because I don't know what the bank loans are. Like, these are probably a lot higher or lower depending on like whether or not rates go up or down. So I just basically did his bond rate. So if it's a single B, it's 5.19% chance of default. And for a D, unfortunately, there's no way for me to really tell, because the lowest it goes in this template is C's. So I unfortunately cannot tell what a D rate is. So unfortunately I cannot tell what a D rate is, but I'm just going to assume it's 100%, but I didn't include it in the bottom over here. So if we weight all these hold-ins, there's way more hold-ins than this, but I basically included the top 1, 2, 3, 4, 5, 6, 7, 8. I include the top 8 hold-ins. So in the weighted interest rate, which is 2.52, the weighted default, the weighted interest rate, no, the weighted credit rating is 2.33%, which is pretty misleading. It's double A. It's likely misleading. Weighted default rate. So this is a lot lower for the weighted default rate. I did the total assets times 0.09, which is double A. So then double A rating is 0.09 per year. So like that's very, very low, because like that's based off the weighted credit rating. So like this is likely misleading. This is like probably the lowest you can get is 0.278, which does include the D grade and the other C that's in here, which is Nico Securities. So including Subaru, it's basically 9.59%, because I'm assuming 100% default rate for. But if you want to actually do like the middle of the analysis, which is 0.987, not including the Subaru default of 100%. But if you want to do the highest default rates, it's basically 8.6, because 8.6% of the weighting is in Subaru, which is D. And you're going to assume 100% default rate after a year, because like that's like the lowest rating you can get. So no probability of default for D grade companies, so assumed 100%. And you can basically see why I'm kind of bearish on Subaru. 1.27 times interest rate coverage ratio, which isn't that awful for a D grade. But the yearly capex has me pretty worried, because they're investing more in the business and not liquidity. They have not a lot of T-bills and cash, 641 million. So like the cash to market cap isn't very good. And then They're paying about $984 million a year in dividends, which they shouldn't be because they're near bankrupt. Expected cash in the next 3 months is $193 million, so they're going to expect to lose about almost $500 million. Okay, let's turn off this. So we got credit spreads over the CD rate. So we get T-bills, so you get 0.84% interest minus the CD rate. So you actually lose money versus keeping your money in safety. There's no default rate on T-bills. You could probably potentially assume one, but they're known as a risk-free rate, so I'm assuming no risk. Prime mortgages 4.84 minus the CD rate, 3.5% net spread over the CD rate, and then 3.5%, 15% chance of default. You can do 3.7 like in the other slide. Yeah, so like right here you could do 3.73%, and then you could do 19% for the subprimes if you're really bearish. So basically, the prime mortgages are near break even after accounting for defaults. The subprimes is 7.25, 1.37 CD rate, so you get 5%, which looks pretty good out of all these. But 16% average default, you get -10, or if you get the good year, which is 2002, it's 7%. So you lose about 1% accounting for default. Consumer loans 11.17, that's 9.83, and 4.21 average, so you get 5.62. But if you're assuming the bad year, so if you assume the bad year, which is 7.7716, I believe, you can see it's right here. So like in Q2 of 2009 is when they had the highest percent of default. So you still make a good profit off consumer loans potentially, which I'm assuming are credit card loans. They could be auto loans or other types of loans, but I'm assuming that they're credit cards. Business loans 6.15 average. So I basically summed up all these interest rates and got the average and the median, because I feel like that's way more accurate to a certain extent than doing 2.52 of the weighted off the top 8. As you can see, there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. There's 15 whole ones. So about double the amount in the sample I did for that thing. So I feel like it's way more accurate to assume the median in this case, which is 6% is the thing that shows up the most. So 6 minus 1.34 is basically 4.66 median. Assuming no D grade, so I used the middle of the road over here. I didn't use the low grade, which is the low one is basically off the misleading one, which is checking my references. So if we go to like right here, I'm gonna get rid of this. So basically you have A versus A grade is 2.6, 4.3, 8.2, and an 8.6 for that, and then B is 13.7. And then I just did 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And then I got a total of 2.3. So you can basically see, like, so basically the average was that. So with the D grade, not including the bad one too, which is also the triple C nickel equal securities, I did not include. I should have. So it's likely higher than 9.59. But like if you assume no D grade in their portfolio, it's 3.67 after the chance of default. But you basically lose money. So most of their loan portfolio is actually losing money, accounting for defaults. But the net spreads look really, really good. And then just to show like the dangers of buying the bond that we covered before, right here, the actual bank bond that you can buy, that's doing 2049. you're buying it for such a low yield to maturity at 3.34, but the coupon rate is 3.25. So it's trading for a slight discount. But the thing is, not owned by the bank. So you're getting 3.34. So you're actually making a net spread of 2%. The 1.91 account for that. Account for like the default risk. But like the Macaulay duration, modified duration is so high. So like if bond yields were to go up by 1%, you'll lose 16%. So then like if it's trading at like 992. So you're gonna lose or make $160 per every 1% increase. So like basically you could see this bond drop a lot because it has such a low coupon rate. So it's very, very volatile. So hence is why I would not like this. And here's where I basically explain that they're misleading. The banks can be misleading, as I only did weighted average for the top few holdings to 3.9, and I did median for the entire business loan book, but doesn't account for weights of assets. Another one I did was the weighted credit rating, which is 2.3 or A or AA, which can be misleading as 9% are in C to D grade. So out of all the bank loans, this was probably the most hardest to analyze, and also the yield spreads. So AAA is 4.5, that's single A, no, that's double, 4.5, and that's 5, 5.5, 6, 6.5. And you see there's a big little jump from single B to triple C, only with 25 basis points versus a full 50. But you can see the net spreads go up, but are they worth the extra default? Probably not. Way default, all hold-ins, so you get 7% in T-bills, no cash. So for this bank over here that I covered, the weighted default is 4.54%. Here's the consumer loan portfolio. I did realize you can get an asset allocation, and you can also get the rates. So that was like the interest rates, and I think this is the portfolio weights. Like I include that above. And you can also see they have some government bonds. With their interest rates being so low, look how much money they made on the government bonds, and yet they don't want to take that gain. So 5 would. Yeah. So the NIM for this company. So you get weighting of their T-bills 0.84%. Prime mortgages 4.5. So basically, if you weight average all that, 4.53%, 5.43, sorry, rounded. And then we have CDs 1.34%. It's variable rate. Most of their 92% of basically their liabilities are in CDs, which are variable rate, which is a little bit scary. The good thing is I covered the interest rate swaps. Interest rate swaps were 90 billion, but still like $1 trillion in ones. So that's billion, 10 billion, 100. Yeah, so like $1 trillion in CDs and only 90 billion in interest rate swaps. That's probably not enough to really hedge out their variable risk of their CDs. But if I were to buy out this company, I would basically sell off their bonds for $79 billion, issue a bigger bond than $21 billion. That way they have a bit more of a spread of fixed and variable, and maybe increase the interest rate swaps, because it's $90 billion isn't too much. It's only 6% of assets or 42% of their equity. Their equity seems good, but like mine's is basically too high at 9.99. So we get like their NIM. So basically their total borrowing cost is 1.37%. So that's their WACC, but it's based off their debt, not their equity. So net interest margin, 5.43% off all their assets, minus the WACC debt. So you get the NIM of 4.06%. So you do 4.06 minus the 4.5% weighted default rate, which we get weighted default rate over here. So it's negative 0.485. But for 9% of the loans being D grade, you can see like how more complicated this can get. So if it's 9.59%, not including the co. So we get 4.06, 9.89 I believe it was for the chance of default. So you can see basically this bank is losing lots. That's where I'm getting their loan to deposit ratio, their bad debt ratio. And here to end it off, we're doing most cash. So you can see there's a option in the game called cash to market cap, where you can look at companies that have more cash than the market cap. And in this scenario, with the rates being so low, I'm surprised to not see much. Like there is another one that I could have bought right here for 190. National Bank of Australia. Like that one would have been actually a pretty good buy too in this scenario. Didn't realize that until just now. But I looked at US Bancorp. So I bought them for $178 billion to buy out all those shares. And their total cash is $202 billion. So I basically got it for, I paid $59, but I looked at the before the bond sale at $47. So when I bought the company, ironically, it crashed. But then what I did is I went ahead and looked at all their long and short bonds. You can see that they made like 48%, 52%. So if I do like I forgot to sum up the profits. 91,645. So they have about 125 billion in profits off their government bonds. So what I did is I basically dumped those bonds and I did 50% primes, subprimes, consumer loans, and no bonds and cash. And I basically cheated because I didn't want to wait a while to hit the mid game. So I did $200 billion and I was able to take over this company and then sell all their bonds. So the height was 150 about, you can see on this little chart. But after the Q1, after the sale, during my Q1 report, it dipped to quite a lot. But you can basically see how you can basically print money. Like we basically made 129 minus, so we paid 59.37 divided by 59.37. So we made about 117% return. Likely a lot higher with the 150, unfortunately, and plus you can also use interest rate swaps in this scenario. So that's just the advantage of doing most cash. Like if you want to do a cheat run, you could start off with $1 trillion and then just start off with your personal company and just buy out all the banks and then just hit a very, very high number. But like I like to grow my bank over a long period of time and then do most cash just to have multi-trillions in the game. So I feel like that's one of my favorite features is most cash. Here's all my references. So we got the man lifts and the barbell. And we got the leaps. Oh yeah, that's also how I got their probability of default for the bank loan. So you can see over here the probability of default was 0.9 right here. That's how I got it. So like 11.5% weight probability of default because it was a single B. I didn't include the D in here. We also got Leap's definition, which I covered. Theta, time decay, percentage change calculator. So I just did this for the government bonds and everything else on Barbell. So that's what I covered a little bit earlier. So the pros reduces interest rate since short-term bonds can be reinvested into rising rate environment. Includes long terms which deliver higher yields than short term. Offers diversification, short and long. Can be customized. Interest rate risk can occur if the long-term bonds pay lower yields than the market. So that potentially there could be an inverted yield curve. Long-term bonds held to maturity tie-up funds. So like that's also a big concern is that they have a higher Macaulay. So we could potentially tie up our money in the long term. Inflation risks exist. So I basically want to do it when I think rates peak. Make it equities and bonds can increase market risk and volatility. Here's the idea that I had for basically the barbell idea. So he has like a bit of a different portfolio than me. So he has the low risk and the high risk. So this is where I got the idea. So like basically we have the crypto at the high risk and then cash and T-bills as low risk. And we got bound ladder and what it is. So at least 10 runs in your bound ladder. But I usually do at least 5, like I do 1 to 5 years. Tactical asset allocation. So this is where basically I would change the asset allocation. So like for example, so like less instead of having 10% cash, maybe I'll think I want less cash to buy good deals. So it's like an active stance. That's what we're going to be doing. So like we're going to break the 50-50 rule. Prime, the consumer loans. What's a good LTR? Already covered that. We got the subprime loans from the Chicago Fed. We got the delinquency rates for credit cards from the from the Federal Reserve. Provision for credit losses, what it is. So this is also known as PCLs. An estimation of potential losses that might experience due to credit risk. Provision for credit losses is treated as an expense for the company's financial statements. So earlier when we were covering that, the PCLs were 2.5 for the bad loans. And we got the yield to call video, which I covered in last time. So I did PMT, FE, and PV. I think he covers it later on in Excel, or that's another video that it probably never. Macaulay duration, which I covered in the last video.
Macaulay, we got the yield, the last one.
And we basically weight all those payments. Period times weight, and you get the Macaulay. Modified duration, which is from the same guy, I believe.
In this video, here of 6% equals
bond convexity, I believe.
Sum divide by more than $1,000. Just present value on the
interest rate coverage ratio. So I covered that in the last video. It's EBIT divided by the interest expense. So we're looking for companies with high coverage. Distress template. But it's this little tool we have right here. So I have like this little source, which was all the default rates. And the bond template, so page 10, same thing. Okay, so I guess I don't So I feel like it's about time we probably go ahead and we could probably do a new like a series later on our bank that we started, or we could continue doing the bank strat, or we could do this barbell where we did the insurance. So like I had 3 potential series ideas. So I think it's about time we probably try Spence's Speculator. Let's go close all the tabs, free up some RAM. Simplify everything. We're gonna probably try level difficulty 1, and let's just do half it at 15 years. Cause I feel like making this quick. We're gonna go and get all our little tools out. Okay, so now we're gonna just fast forward till we get our ability. Okay, so now we passed our background check. So now I'm going to play on probably 75 speed. Because 99 I can play on pretty fast. So we're going to do 25 grand into the Bitcoin. Don't really care about the price as long as we get in. Later on we are. So you see they have a lot of Bitcoin, a lot of cash, a bunch of bank loans. 90% portfolio income, non-interest rate swaps, management fees 0.2% of assets, AAA rating, minimum 1% annual rate. Okay. So we got a $25,000 budget, and the ask price is 122. 5 cents. So we're gonna buy about 204 shares. We're gonna go a bit above budget. So that's 25,014 bucks. So we now have Bitcoin. So now we want to go ahead and buy Ethereum. 0.2% of assets. NAV is A1. I forgot to look at the NAV of the Bitcoin. So NAV is A1. So the net worth is actually higher than the current share price. So it's kind of like looking at the price to book value. So right now it's actually undervalued based on that. Doesn't have any earnings. So we're gonna go 25 grand. Divided by the ask of 78.80. 317. So it's less than 25 grand. So we're about 50-50 right now. We've already lost money. So we got about. Yes, we got a little bit over 50%, I believe, in cash and cash equivalents. Right now, interest rates are kind of moderate, so we could probably go a bit of a barbell. I feel like it's a lot of work and time to do modified duration, Macaulay duration. Like right now, I could bet that rates go down. So maybe let's just do a 3 and 10 strat. Interest rates are kind of moderate, but at the same time, like I'm gonna regret like how much profit do we have? So I guess we could probably do 3. 49.96.12. Let's just do it in thirds. We'll go a bit more on the shorter end of the curve. So we're going to do with about 30 something thousand is the shorter end, and we're going to do some on the longer end. Research bonds. So we'll choose, I think the current year. Current year is 2026. So we could probably buy some Lukoil bond at 8.6% coupon yield to maturity, so we're paying a slight premium. But this is like a long term. We're gonna buy this only at 16,000. So it's a bit above par, so we'll just buy 16 of them. We could buy 15 theoretically. 16,300. Okay, now we'll buy a 1 in 3 year maybe for a 1 in a 3 year. So we'll probably buy 16 of this. $15.6, and then we'll put the rest into a 3 year. So we have bond portfolio, we have 2049, 2027. So we want a 2029. 2029, that's pretty risky. We're gonna YOLO everything. We paid 17,000. So right now we can see if our asset allocation is about 50-50. It's probably a little bit different. We have $450 in cash. We could probably buy more Bitcoin if we wanted to, but I'm good. So 49,933.28 divided by. So we're about 50.15. So we have less than 1% cash. So we have a bit more stocks and bonds, but at the same time we're a little bit 50-50. Our corporate bond interest is 16,000. We have 16 grand maturing in a year, so that's the 8% one. And so we're gonna be getting 19,000. But if interest rates go back up, then the shorter duration stuff will pay off. But I wanted to take advantage of this Lukoil. I could have bought a corporate actually, and then maybe that would be more sensitive to the rates, because I might not make as much interest rate profit than buying a corporate. But I'm basically trying to benefit from moderate interest rates by doing the barbell, but mainly sticking to like the shorter end, because I know that if interest rates go up again to 6, then I'm in a lot of trouble. But we also have the Bitcoin to like make some capital gains, so it kind of helps for everything. And now we're gonna go ahead and fill those equities. So we got share price of 123 for Bitcoin, 82. And we actually probably want to know the price, the NAV of Bitcoin. 118, so like it's a little bit above NAV. And the Ethereum, yeah, so the NAV is higher than the current price. So the Bitcoin is probably a better value play right now than the Ethereum is a better value play than the Bitcoin. But I'm acting for momentum on both ends. And probably if I make a 50% return, I'm gonna probably, if I make 25 grand on Bitcoin or Ethereum, I'm gonna trim and maybe go into more bonds. But I'm likely in the latter, because unfortunately I went barbell. I kind of wish I went longer, but I didn't know whether or not rates were going to go up or down. Well, in the early game, they often go down, but yeah, so Lukoil has made us some good money because we bought long duration. Might be good to actually ditch those bonds and then go back into laddering, especially in the long duration. See how much money we made off this. So it's 204.08 minus 182.62. Oh, we made about 66% so far on Bitcoin. So I'm thinking we go ahead and maybe trim out the 16 grand and put it back into Bitcoin, Ethereum. Because I feel like, yeah, maybe Bitcoin continues to have more momentum on it, but it might be good to go ahead and swap between the two because Ethereum hasn't moved much. So I think that's actually the play. So we'll sell 16 grand of Bitcoin. Yeah, sure, there could be more momentum, but I want to trim out my profits and potentially make sure I have pretty good wins. So we have 26. So maybe I should have divided it by 2, and that way I have 50-50, but right now I think Ethereum is a bit more of a better play. Cause, oh yeah, it's a little bit above the NAV now. Ethereum is 90%. Closely tracks the fluctuation of Ethereum. AAA. This cryptocurrency, so they lost 8,000. So they're paid about 5.4k, and the current price is 2.7. So they've actually lost money on Ethereum. But Ethereum, if it goes back up, then it'll be nice. So we're gonna go a bit more heavier into Ethereum than Bitcoin. Hopefully this plays off. If Bitcoin continues to have momentum, at least we trimmed in. We buy 189, why not? Have no cash. So now we're a bit more heavily weighted towards Ethereum than Bitcoin, but we already have a good profit already on Bitcoin. So I'm hoping that Ethereum has a bit more gains in it. Yeah, sure, there could be more momentum and potentially Bitcoin, but yeah. Oh no, Bitcoin's losing a bit of its momentum. Okay, so now I think interest rates have bottomed. So now we're going to take our profit on our bond. So it was, I kind of wish I got the Macaulay on this and the modified duration, because that's a lot of work. Plus, I'm just more interested in playing the game. Oh. So we made about 16% on Lukoil bonds. So I'm thinking we just ditch out that entirely because I think interest rates have bottomed out. $18 grand, not bad. So now we have. Okay. So I'm going to go more into Lateran because I think rates have bottomed out. So we have 2027, 2029. So I want to go into probably some 2028 Corp. That's convertible, so it has 0% yield to maturity. But that would be considered like a middle of the risk pack. But it could be, I could have allowed it. Could have allowed convertibles. 2028. Yeah, let's buy this. Guess we could look at the interest rate coverage too. Info. Ooh, yikes. Dividends reduction, so it would be 42.75 plus 100. So it's like 80, so like the interest rate coverage is probably less than 1 or something about that. It's not a long duration though, so we're gonna go 18 into this. could possibly get a downgrade, hopefully not. So as you can see, like, we're kind of breaking our rules. So we have 68,411 divided by 122, 193. So we got about 57% in crypto, and then the rest is in a little bit in cash, you know, mostly in. And like I said before, the Bitcoin, I sold it around 200. Now it's almost at cost. But like the Ethereum hasn't moved as much as I wanted it to. Interest rates are still low. Capital gain $47. Thank you. See, like Ethereum's made some good profit. Just gonna keep that in cash. Some real safe stuff. Wish we did longer duration stuff, but we're just gonna be laddering for a little bit. Probably up the speed. Yeah, it seems like Bitcoin has a bit more momentum in it. Ooh, 190. Yo, let's go. I saw Ethereum hit 100. 93.62 minus 81.33. So we made about 15% on Ethereum. So it's not close to our 50% profit. So you can see this company got some issues with it. Undeclosed them out. So let's just hope that Ethereum has a bit more momentum in it to go above 100. Okay, let's actually double check. Probably. What's this? No, it's company info. Yeah, so it went from 2.4 to 3.22, but they still lost money on their Bitcoin, on their Ethereum holdings. Oh, did Bitcoin crash? No, or like they just split. Okay. Ethereum. Oh. Ethereum is 104 dot. So we're at 28% gain for Ethereum. So maybe that's 130 or something. We'll probably trim out. And interest rates are back on the rise, so thank goodness I went to a bit of a ladder in. So we have 2027, 2028, 2029. Got rid of the 2040 bond. And we're still getting some good cash flow. We have 20 grand, so we're gonna have 16 grand mature soon. We got some dividend income, some corporate bond interest, and we got some T-bill, some not T-bills, but we have CD because we have rates, because we have cash. We have cash with the bank. So the CD rate's going to continue going up. Okay, it's almost 111, 113. So we're about 39% on Ethereum, so it's almost near the trim price. So it's probably closer to 130. You know, we're going to probably go back into Bitcoin. Oh, Ethereum's losing some of its momentum. Damn, we just lost out on 30% return so far on Ethereum. Dang it. Should have took the 30% return. Could have put it back into Bitcoin. I think we're down on Bitcoin now. Yeah, a little. We're almost break even on Ethereum. Ugh. Feels bad. The rates are back on the climb. I'm gonna buy some more Bitcoin just with all my cash that we have because we lost money on Bitcoin so far. Could keep dipping. We're about 2,646 shares. We're gonna have 16 grand coming due, and we're gonna extend our ladder. So that's why I like having the interest rate. It's like we get 3.7k back, or we have the 16k, but the 3.7 could be used towards buying more Bitcoin every year. So it's like $3.7. It's like $308 a month. That gets paid semi-annually because it's a bond, but we got 3 bonds. So we're probably the crypto market's just taking a dump right now. We lost quite a lot. I think the Ethereum we made money on. So I think right now is probably where it's a good idea to probably break the rules, like once we get the 16 grand. So it's 2026, 2027. It doesn't say when it's exactly due. I think it does if you buy it. So right now there's a bit of a value discrepancy between the two. Okay, there's a big one now. Oh, dude. Okay, I think it's time we trim. So we're gonna trim 20 grand of Ethereum and we're gonna buy Bitcoin. 121.42, 164 shares. Let's do 165. So it's less than 20k. And we're gonna go ahead and we're gonna put all the money back into Bitcoin. So make sure we have, yeah, we got 20k. We don't have more than that. Bitcoin Trust, we're gonna buy 542 shares, 20 grand. So now we're a little bit more bullish, like we have a little bit more Ethereum than Bitcoin, but we've averaged down our share cost on Bitcoin quite a bit. Should have looked at the average share price before we bought, but so we're basically bullish on Bitcoin, but we're gonna keep our Ethereum just because it has momentum. So right now we're more bullish on Bitcoin than bonds, but as interest rates go double digit potentially, I might be. So we're 50% before 139 dot. So we're 72%. Maybe we can get closer to 100%. But I could probably take another trim. Yeah, like I think Bitcoin's having a bit more momentum on it. This may be a bad play selling all of the Ethereum, but it's alright. It's had quite a lot of momentum. They're giving it a hold, so I think we trim. So it's 138 ask. It's about 145 shares. Let's round it. We don't have to. We'll like stick it rounded, but just gonna add an extra share. So we got 20k. We realized 8k. Now we're gonna go ahead and buy more Bitcoin. So now we're more share value. So we're way more bullish right now on Bitcoin than Ethereum, but we still have a decent amount of Ethereum. But we're gonna bet that Bitcoin has a bit of a comeback. So we had like 46 average cost, and now we have 52. Let's just hope it doesn't go down to the 20s for Bitcoin. I want it to go above 100, and then we have lots of shares. $20 grand. What do we got? We're at 32%. Okay, so the Ethereum just had a stock split. So we want Bitcoin to probably hit closer to 80 before we consider trimming. Which is probably me being a little bit greedy, but it's got momentum in it. Probably up to speed again. I don't care, we do whatever. So we want Bitcoin to probably closer to 80 before we consider trimming. 60s is pretty good though. And interest rates are about moderate, but they're still... Okay, 72, that's tempting. So 59%. I say we trim and then go back into... We could consider doing some barbell and maybe do like a 10-year. At the same time, rates are back on the increase. Maybe keep some cash. 35 grand sounds pretty good though. Yeah, maybe there's more momentum and we could potentially make more, but I don't want to be crying when Bitcoin takes a dump. So we're gonna get 35 grand less than that, so about 34.9. Probably. Do we want more Bitcoin? I don't really know. It's where I'm having a difficulty because bond yields aren't too high yet. So I think we just look at how much we have. 36. So we got about 20% in cash, like 19.91. 91.822. %. So we got 20% in cash. That's and so we got the rest in bonds. CI bonds were paid back. Okay, so now let's extend the Bitcoin. Like Ethereum looks like it's about to fall a bit. So 2028, 2029. So we want to probably do a 2030 bond. Let's extend our ladder. Why not? Like we're underweight bonds, but I like a lot. So we got into 2030. So we got 2020, 2027. So we We got 2 so far, so we want to do 3 more bonds. So we're going to do 17.5 about. So we'll do 2030 and above. 2030, 6.3 yield. 6.5 for triple B. It's convertible. Double B. This one has a higher yield to maturity. That's 108, so we'll probably buy 16. What is that? It's about 17 and a half. Yep. Okay, so that's 1. So we got 2020, 2029, 2046. Oh, we got some long government bonds for some reason. Might have been that thing that happened. I don't really know. That's a little concerning though. So 0, we take the 17 grand. Or we keep it as our barbell. 2028, 2029. I think we keep it as the barbell, but even though rates are kind of moderate. But we keep buying some 20. So we got 2029, 2028, 46. So 1, 2030. It's a little bit over par, so we probably buy 17. 7.03. So we got 2028, 2029, 2030, 2046 for some reason. That's very sensitive though, that's my only concern. I think Bitcoin's a good deal actually. So we got 17 grand with some government bonds. So we're 71,000 divided by. So we're about 41% in fixed income. A bit of cash. So we could probably buy a 2031, and that way, like if interest rates go back on the rise, the 2046 won't wreck me. Or we could continue doing more Bitcoin. 2031. Yeah, I'm probably breaking the barbell. I'm probably buying some intermediate bonds just because I want to buy some ladder in. I think interest rates could potentially keep going up. Because we have leverage now. I don't want to buy the stock now. 16. No, we don't have leverage unlocked. We're close though. So right now we're 8,000 divided. So we're about 50-50, which is pretty good. But my only concern is that if rates keep going up, at the same time the government bond will probably benefit. So the current year is 2027, so the hard is 2031 minus. So yeah, we're probably, like, the 2031 is probably considered an intermediate bond. So we probably broke the bond barbell technique, but at least we're all laddered out. And right now we're gonna reinvest we're gonna start buying some big Ethereum again. So we're getting 6K in corporate interest, $1,000 in government, so we're getting $8,000 a year. So let's go ahead and just start using our cash flow from our interest towards buying a little bit of Ethereum every now and again. We're gonna buy 12 shares of Ethereum. Start lowering our cost basis. We're at 26. And let's just see how much we made on Bitcoin, because we have too much Bitcoin, honestly. 84.32 minus. So we're at 87% gain on Bitcoin, so I think it's about time we take our 32,000. Divide by 84.4. Oh, 80. Let's sell about 380 shares. We're going to reinvest that back in Ethereum because we're near the cost basis. So right now we're probably way more in Ethereum. Yeah, but we're almost 50-50 mix. So 38,464 divided by. Yeah, so we're about 42% Bitcoin, and the rest is Ethereum. So right now we're way more bullish on Ethereum, but Bitcoin seems to be having a lot of momentum to it, so the 40% should work with us. Oh, there's a trigger in Wall Street. And interest rates keep rising. So right now, like it was kind of stupid for me not to sell the government bonds, but at the same time we did do a bit of a kind of barbell-ish technique, so that should help. And plus, if interest rates keep rising and Bitcoin keeps rising, or Ethereum keeps rising, then we're in pretty good order. Oh. Oh my god, look at that. Oh, they just split. Okay, I was like, they crashed. Plus, we get a higher dividend yield. Dividend income 1,000. We're getting close to like 10,000 a year in all of our holdings. So now we got time working on our side. We're snowballing. We just hope that Ethereum keeps rising. Yeah, we got wrecked a little bit on the government bond position. We're down about 12% on the government bonds. And we gotta wait like a long time before they mature. So I think it's about time this may be done. This may be pretty dumb. I'm gonna probably sell a little more. Like if rates crash, I'm gonna cry, but just sell our shares. Got loss of 2.3K. Question is, do we go ahead and buy more Ethereum because we're evenly matched right now? Sure. Yeah, now or not really. 68. Yes, now we're 38%. We probably want to keep that in cash. Even though Ethereum seems like it's a good deal. Ethereum just keeps getting cheaper. Right now I would love to buy a leap on Ethereum, but we don't have 400K. Looks like interest rates have kind of peaked. ease in. Okay, we're gonna go long, even though we just sold the long. Let's go to long duration. Long duration. Single A. The current year is 2027. 24 years to maturity. So then which one was it? Let's go look at. This is 2051. Is 3.36, and it was how many years? 24. 8% chance of default to the end of term. Got a low yield to maturity. Probably a low coupon too. It's probably heavily volatile. Yeah, we put quite a bit of money in there. I'm surprised that one fell a lot. Yeah, we're in a bit of a barbell. Besides the 2031. $7K. 26K. So we're in 18. It's almost bedtime. Oh my, the interest rates keep calling. Oh no. Long duration is not a good play. Our cash flow, we're getting 18K. So if interest rates keep climbing, I think our barbell is actually going to play off. So let's just hope that they climb slowly, and by the time that's due, we can keep locking in at longer durations. Right now, I would consider doing bonds over Bitcoin. Same time, Bitcoin is hella cheap, especially Ethereum. Ethereum just seems to stay cheap though for a while. So we got about 1,000. Let's go and YOLO that into some more Ethereum. Oh, we can buy the Ethereum balance, but we'll buy 43 shares of Ethereum. So now we're kind of evenly matched with both. We got one at the end of the year, right? 1 2028, 1 2029, 1 2030, 1 2031, 1 2051. 2051 just keeps crashing, went from 68 to 62. Ethereum keeps crashing though too. It's gonna keep putting our interest. Oh, they don't have any bonds, so I keep forgetting. Oh, we bought government bonds by accident. I meant to buy Ethereum. But hey, at least, what is it? Government long. 8.84% yield to maturity. Not bad. So right now interest rates are double digit almost. I was hoping that Ethereum would be on its way up, but it's been not having a good time. Oh yeah, Ethereum is at its lowest now. So I want to sell 372 shares of Bitcoin to buy Ethereum. Okay, so we have average cost of 30. So if we put cost of 30, we went from 30 to 25. So that makes me feel a little bit better. This sucks that interest rates are double digit now. Almost. I'm excited for the 18 grand. Honestly, I'm gonna see what it's going to do. I'm guessing because interest rates are so high that like they just 28, we didn't lose much. We can honestly ditch that and go back into more of a longer into the barbell, and we got 20, 29, 20, 30, 20, 31. We got 2046 and 2051. Almost 2028. Yeah, I think we sold the 2028 for a small loss. It could probably, what is it trading at? Oh, it's trading a bit at par. We bought a bit above par. But like, I'm okay with taking a $500 or $400 loss in order to go into a little longer into the curve. I think we go ahead and we buy up the bond government. 10 grand. Government long 8.676. So we got some 2029s, 2030s, 2031s, 2050, 2046. So we got a good mix of. So if the next few years, like by 2031, if interest rates keep going up, we'll be able to lock in. How much cash do we have? 1.6. Let's go back to Ethereum because it looks like it's having a bit of a resurgence. So we're a little bit more balanced right now than Bitcoin, but we're starting to we have a lot of Ethereum. So if Ethereum takes a dive again, we're in trouble, but it's taking a bigger dive than the Bitcoin. So I'm hoping it has a bit more juice in it to help perform. So we got no 2028 anymore. We got 2029, 2030, 2031. So if interest rates go back up by 2031, I'm not going to freak out, but I want to take advantage of the. We could probably sell the 2030 again. It looks like interest rates are going back down. But who knows? Maybe. What are they doing? They're easing. 2029 or 2030. We're about to make money on the 2020. Sure. Wow, 2030 and 2031. That's our backups in case things take a dive. We're gonna buy some because we're getting 8% yield maturity for. So double A 2051. This goes to 2028. 23 years. And what is it? Double A. So if it's 23 years, it's that. 24 years, it's 2.14. Cool. Okay, so we're betting Ethereum and Bitcoin will go back up. You can basically see that interest rates have been taking a dive. We're going to continue betting that they're going to have a dive. We're going more aggressive in London. 2030. I feel like it might be good just to do a bit of a bull into the longer stuff, honestly. Maybe just keep it 2031. We'll just keep our on ladder. We could theoretically make more money if we. Like, GDP growth is still strong, so I think bullet's best. Because right now they're easing. They could continue easing, or they could just hold flat. Plus we could theory just 1.5. Let's go and check which one. That's more Ethereum. Yeah, we should have bought more long duration, but I wanted to make sure we have a barbell just in case if rates went up by 2030, 2031. I think that's what we had. 2030, 2031, but we have some longer and stuff. This, like, the long government's actually doing really well because it's very, very sensitive. Oh, it's the 2051 Corp. But then we have a higher weight in the government. Okay, bond yields keep crashing. Then we can go ahead and go into more Bitcoin, Ethereum, and go back into Ladder. War ups again, and Indian subcontinent tensions increased in latest Pakistanis in war as Indian tanks and troops broke in on Pakistan's Kashmir rolled in Pakistan, moved in directions has been bad. The war between the two powers is not yet escalated into the use of nuclear weapons, but Pakistan is threatened to obliterate even if India's forces don't halt their advance to Pakistan immediately. Global markets tumbled, but shares of aerospace have went up. And other militaries are expected to rise. So yeah, markets haven't taken a tumble yet, but they're going to. Oh, interest rates went back up again. Probably because of the war. So thank goodness we kept our little barbell. Because we got 2030, 2031. So in the next 2 to 3 years, if interest rates go back up, we can. There goes our profit, our $6 grand profit in government bonds. Bitcoin and Ethereum haven't really performed it that well. Let's go ahead and start increasing our Bitcoin. You need to go into the hundreds again. They've been Not doing all that well. Oh, interest rates are back up. Sucks that we have our barbell in the 2 to 3 year range. Should a little bit laddered in a bit more on the 2029, 2030. Well, I was expecting interest rates to go back up again. It seems like they're tightening, yeah. And our Bitcoin hasn't really done all that well, so we've been kind of flat. And most of our portfolio, unfortunately, is long. Oh, we're in a bit of a pickle. If Ethereum and Bitcoin perform well with the raise and rate environment, and we get our... So we could probably time things well if they, in the next 2 or 3 years. If not, then probably hit the bed. Okay, time to win more Ethereum. Because we actually lost money on Ethereum. Nope, we don't want to buy government bonds. Could. Yes, we're now evenly balanced between bonds and Bitcoin. The bonds are likely going to take a big dive because I'm in long, and rates are back up. We have 2 or 3 years before we start panicking again. That's the nice thing about having the short end, is I don't have to worry about the next 2 or 3 years. Let's just hope that they probably go double digit and we can lock in 15,000 and 16,000 and a very, very long end. Then all these others that are very, very long, like 2046, 2051, 2051. Yikes. Probably look at her Macaulay, honestly. And then Bitcoin and Ethereum just keep taking a nosedive. Just haven't recovered. So NAV is 20. Yeah, NAV's like, yeah. Yeah, they're a little bit overpriced. It's unfortunate. They haven't recovered all that much. Yeah, if up at 2,000. Jeez. Yeah, really get lost. I'm just hoping that Ethereum continues to have a climb. Maybe interest rates go up again, and then our barbell plays off. It looks like they're back down. They're going down a little bit, or at least moderating. Start buying more Bitcoin again. We're very low on our Bitcoin supply. So we got like 2 or 3 more years until we start panicking about interest rates and about our crypto not performing. So like after 2031 we stop playing them, and then we do another 10 years for the next one. Probably do. Then we could probably do the banks and everything else. Are there still A's? Didn't say. Yeah, Bitcoin's been taking a dump. We're about at cost for Bitcoin. We're a little bit money on Ethereum, but not a lot. Oh, there we go. We hit 200K. Now we can start taking out leverage. So Now we gotta pay attention to how much budget we have because I don't really want to go into leverage. We're making about 8K a year, not bad. It's more money to DCA into Bitcoin and stuff. So we actually, Bitcoin actually just had a bit of a bump. Yeah, that's a big bump from 24 to 48. Something happened. So I was just hoping that that happens too when we go buddy Ethereum. Oh, we should more into Bitcoin. Yeah, especially if it goes into the 60s now. Jeez. It's gonna be stupid, man. I'm gonna go ahead and do 24. So I'm gonna sell for Bitcoin and buy more Ethereum. Hoping. I wish I could just buy options right now. I would buy a leap on Ethereum and then just keep my Bitcoin. How much budget do we have? We have 26,500. The ask is 1,290. 48 bucks, whatever. So now we're 100K. %, Bitcoin, the rest is bonds, no cash. Okay, we got an average cost of 23 for Ethereum, so hopefully it goes to the 60s like Bitcoin did. Didn't see the Bitcoin going up so much. It's crazy how much it went up from like the 20s to 70s, 60s. Did choose a good time to sell at the 60s. It's going to the 40s now. Interest rates are moderating. Still got a year, 2 years left until we have to worry about bonds. Okay, Ethereum's starting to make us some money now. We're up about 30% on Ethereum. And with Bitcoin crashing, it actually might be a good idea to reinvest the profits eventually. And when Ethereum starts hitting the 40s. Interest rates are back on the climb again. %, so I could probably take the 50 grand profit. And then maybe go back into laddering. Yeah, it's probably the best play. We're about moderate rates for now. Still about 50 grand of Ethereum. Because we want to go back into laddering. $1,006, 1,361. we buy? Oh, I think we bought by accident. I think we might have bought by accident. I meant to sell the 50k. Let's hope that Ethereum keeps. No, please go up Ethereum. Oh, I meant to take the 50k and then do that until a bit of a lag. Damn it. Still got 2 more years. Now we're getting 21 grand. 17 grand is coming due for bonds. Now Bitcoin's starting to look like a deal. Damn it. How's our opportunity? 35 up. 42 minus 26.7. Up 32%. Probably squeeze it a little bit more. We're being greedy. Yeah, we are. Start buying more Bitcoin. We're hell low. 2,000. 65 shares. Borrow 100 net $79. Like we're very overweight now. 179.26. 65% Bitcoin now. Yeah, we're not up too much on each though. We should have went into Lateran or a bit more of a barbell. We made more. It might be a good idea to buy out, to check out the 2051 soon. Bitcoin's having a resurgence. Fortunately, I didn't wait much into each. Should have sold 50k of the Ethereum, bought more Bitcoin, but whatever. Seems like the Bitcoin's a better play. But they're not exactly correlated between two. Okay, which are we on the bonds? 2051 Berkshire. That's their most volatile. Almost at par. This is about par. Ethereum's had a bit of resurgence. Up on Ethereum, not bad. Rates aren't that high though. Or if it's 6% of Ethereum, take out $8,000. Uh, 19, 12. 78, 9,000 something. Now we go into more laddering. Okay, how much cash do we have? 23%. 23%, and we're 41%, so we're like 60%, and then the other 40%'s in bonds. So we could keep some cash, or we could start laddering up. Sort of laddering situation look like 2030, 2031. So we got 2 bonds, right? 2029, so that's 2 years. So we do 80,000 divided by 3. It's 16,000. So we'll do 2030. So we'll do 2036. 2036. So we'll do 2032, 2036. 2032. No, we need 2033. 2033. 8% coupon. That's pretty bad for single B. Yeah, okay, 16 of this. Done so far, so we got 2030, 2031, 2032, 2033. So we're doing all the way over to from 2031, so we're doing 2036. So we're doing 4, 5, 6. 4. 6.55. 6.77 for an A. So 2031, 2034. So 2 more, we're done. 35, 36. 6 right here. Six, 7 for some reason. 8. So we got 6. Nice, get 5 done. No, we're done. Okay, we're almost at the point where we can do options. We're gonna borrow 2K, why not? Okay, so we're 150. So now we're a little bit more overweight bonds. $47% Bitcoin, the rest of the bonds. We didn't buy much government, but we made sure to ladder up because we think rates have bottomed. So we got a 2030, 2031, 2032, 2033, 2044, 2035, 2035, right? 2034, 36. I don't think it's get 35, but we have some long ones in here. We'll probably ditch out the long ones. And what do the government ones do? 2036. Probably not worth it. So now we're all laddered up and we have some good bond income coming in. So we got 11 grand, 1.5 grand. So we're gonna about like 17 grand coming due soon. Probably better for us to actually consider doing some more Bitcoin too. We don't have a lot of cash. Oh my, how did I get so much margin debt? Probably is it lateral? I guess I could sell the lawns. It's about time. Pay for margin. Because I think interest rates are kind of moderate to low. Plus we have a good laddering setup, so I think it's about time we pay over margin by. Sell the sensitive garments. So we got 120.51 and we got a big amount of laddering that we're probably going intermediate, but want to make sure we ladder out for like until 2036, that way we're not paranoid. We ever get on 2051. What's our Bitcoin is at? It's pretty high above our cost base. Probably better we just pay off our margin. Do I have sweep? There we go, we split 40. 47 grand to our broker. Like 2031 we stopped playing. Make sure to write this down though. Should we consider selling our 22? It's like 18 grand. Quite a lot, but not too much. Deutsche Bank. Oh, damn it, they called back the bond. Ah. So what was the Dutch bond? Dutch Bank. They had such a good coupon, too. So we got 2031. See, like, that's yield to call, too, in a nutshell. We probably actually made a profit, though. I don't know if we bought below par or 2031. 2, 3, 4, 35, 36. Probably buy 2037 or just do a lawn rate. Like, what are the lawn rates? So the short rates are 6.8 for double A. I want to do at least a double A. So it's 6.3, 6.8. Go as high as 7.3. This one goes as high as 8.3. Yeah, it looks like this is the best one on the yield curve because it kind of inverts over time, but like this one's, yeah, that's a pretty good one for a long one. First, we gotta see how much money we have. 6,000. Probably borrow. Yeah, let's borrow like a good 13 grand to buy that. So, buy 20 grand. Frown books. It's a little bit above par. Bible 18. That's 20,000. Yep. A little bit above our budget. We'll borrow some money. It's got such a good yield of cherry on it. So we got two pretty long ones. 2044. Which 2044. Yeah, so it's about a 10-year. So yeah, it qualifies. Plus this guy could yield like 8% for double A. Okay, so next year we'll look. I'm actually thinking that's probably good enough. It's getting near my bedtime. Yeah, so I'm gonna save this as 20. So we did a good like few years for that. We have 11 more years left. So we got about 50-50 each. A little bit of margin. Yeah, they bought back 33% of their bonds held by. Do we have any Dutch? Yeah, they bought back a bit of it, but they didn't buy back all of it. So right now the market price is actually higher than what they called it at. Okay. So once we have 400K, then we can start using our yearly cash flow towards buying up some crypto whenever I think it gets really cheap. I think that's good enough for today. Well, thanks for watching. Okay, you have a great day. Okay, bye.